What if the next financial crisis isn't a recession? Not even a crash, but a reset? Between 2026 and 2028, some analysts believe we could face a turning point bigger than 2008, possibly even 1929. Not because of one bank failure, not because of one housing bubble, but because the entire debt-driven system may be reaching its limits. Let's break this down calmly and strategically. Globe showing Europe, Africa, the 30-year debt supercycle. For the last 3 decades, global growth has been powered by one thing: debt. Governments borrowed, corporations borrowed, households borrowed. When growth slowed, central banks lowered interest rates. When that wasn't enough, they printed money. Today, global debt exceeds $300 trillion. Debt itself isn't the problem. Productive debt builds economies. But when new debt stops generating real growth, the system weakens. At some point, adding more credit doesn't stimulate expansion, it just inflates asset prices. That's where the risk lies. Collision, the everything bubble. Previous crashes were isolated. 2000, tech stocks. 2008, housing and banks. But after years of ultra-low interest rates, nearly every asset class has been inflated. Stocks, real estate, bonds, even speculative assets. When money is cheap for too long, everything rises together. The danger? If confidence breaks, everything can fall together. That's what makes this different. It's not about one weak sector. It's about interconnected leverage across the entire financial system. The dollar and the global power shift. For nearly 80 years, the US dollar has been the backbone of global trade. Oil, commodities, global reserves, all priced in dollars. But global dynamics are shifting. Emerging economies are exploring trade settlement in local currencies. Gold purchases by central banks are increasing. Some blocs are experimenting with parallel financial systems. This doesn't mean the dollar collapses tomorrow, but it does suggest a slow transition toward a more multipolar monetary world. When reserve systems change, volatility follows. The liquidity risk. Modern banking is digital. That makes it fast but fragile. In 2008, banks faced solvency issues. In a future crisis, the bigger threat could be liquidity. Confidence disappearing instantly. Digital bank runs can happen in hours. And while safeguards exist, governments also have emergency powers. Bail-ins, where depositor funds are converted into bank equity, are already written into policy frameworks in multiple countries. The key lesson? Understand where your money actually sits. Social pressure points. Financial stress doesn't stay on Wall Street. It shows up in grocery bills, energy costs, housing affordability. When real incomes shrink and essential costs rise, social tension increases. History shows that prolonged economic strain reshapes politics, institutions, and public trust. But this is not about panic. It's about preparation, the strategic response. If the next decade brings volatility, the winning mindset shifts from growth at all costs to resilience. Practical steps: reduce high-interest debt, build liquidity outside a single banking institution, diversify geographically if possible, hold some tangible assets, invest in skills, adaptability, and strong community networks. Resilience beats prediction. By 2028, the global financial map may look different. Not collapsed, but restructured. Less centralized, more regional, more asset-backed, more politically fragmented.